Welcome to the deep dive. We're jumping straight into Dell Technologies Q2 Fiscal 26 earnings today.
Yep, lots to unpack here.
Our mission is really to pull out the key insights from their latest reports, figure out what it means for Dell, and maybe what it signals for enterprise tech overall. Let's get right into it.
Okay, so these Q2 results, pretty impressive when you say they really beat expectations.
Oh, absolutely. Record revenue, for starters.
Right, $29.8 billion, that's up, what, 19% year over year, and higher than the $29.2 billion they were guiding for.
Exactly. And it wasn't just revenue. The earnings per share, the diluted EPS, that also came in strong.
$2.32, also up 19% year over year, and again, beat the forecast at $2.29. And the market noticed, didn't it? Stock popped 1.52% after hours, closing around $133.70. Seems like a clear sign of confidence.
Well, yeah, and it's not just that they beat. It's the size of the beat, the surprise.
What do you know?
Like an EPS surprise of 1.31%, revenue surprise over 2%. That's not trivial. It shows they're executing really well, consistently better than expected.
And if you look at Investing Pro data, they've got this good overall financial health score. Plus, that 31.82% return over the last 6 months. That's serious momentum.
So, strong performance, strong momentum.
And it's efficient, too. Look at the other numbers. $2.5 billion in cash flow from operations. Operating expenses actually went down 4% to $3.3 billion.
Yeah, well, revenue's up 19%. That's interesting.
Yeah, and operating income climbed 10% to $2.3 billion. So it's not just growth, it's profitable growth. They're managing costs even as they expand.
Okay, profitable growth. That's key. So where's this growth really coming from? It feels like AI is the big story here.
Oh, massively. The AI momentum is undeniable.
The numbers are pretty staggering. AI server shipments were a record $8.2 billion in Q2 alone.
And $5.6 billion in new orders just in that quarter, which built up their backlog to $11.7 billion.
Right, and get this for you listening, they shipped $10 billion worth of AI servers in the first half of this fiscal year.
Which is more than they shipped in the entire previous fiscal year.
Exactly. More in 6 months than the prior 12. That's a huge shift.
It really is. And they're fast. First to ship the NVIDIA GB200 NVL72 last year. First with the GB300 NVL72 Najah to Core Weave.
That speed to market has got to be a major advantage, right? Especially now.
Absolutely. And looking bigger picture, their AI strategy seems really solid. That pipeline they mentioned, still multiples of the backlog.
Wow. So lots more coming.
Yeah, huge visibility. And they're seeing double-digit growth in enterprise and sovereign deals. So it's not just the big cloud guys.
But diversification is important.
Critically important. And what's key for their long-term health is how their unique stuff, their engineering, their own design and manufacturing, helps their margins on these AI servers.
Ah, because weren't they saying they took some aggressive deals early on with Blackwell?
They did. Aggressive deals, their words. Common tactic, right? Grab market share early in a hot area like NVIDIA's Blackwell.
Makes sense. Land grab.
Yeah, actually. But they're confident margins will improve in the second half. It's a calculated risk. And the goal isn't just selling servers.
Right. It's about attaching other things.
Precisely. Attach networking, storage, professional services. Build out those whole AI factories for customers.
So the complete package, not just the compute engine.
You got it. Become the go-to partner for the entire AI infrastructure stack.
Okay, that makes a lot of sense. So AI is clearly driving a lot. What about the rest of the Infrastructure Solutions Group, ISG?
Well, ISG overall had a record quarter too. $16.8 billion in revenue, up 44%. That's 6 straight quarters of double-digit growth.
44%. Driven by AI, obviously, but still huge.
Within that, servers and networking together were up 69%. Just incredible growth there.
And traditional servers, are they just fading away?
Not at all, actually. They've shown P&L growth year over year for 6 quarters straight, too.
Really?
Yep. And there's this huge refresh opportunity. Over 70% of the servers out there are Dell's 14th gen or older.
Ah, so they're due for an upgrade.
Exactly, to the new 17th gen portfolio. Better performance, efficiency, security, all the stuff needed now.
Okay, so servers are strong. Storage, though, that was down a bit.
Yeah, storage revenue dipped 3% to $3.9 billion. A bit of a challenge there.
But you mentioned bright spots.
Definitely. PowerStore, their mid-range offering, saw double-digit demand growth again 6 quarters in a row.
And attracting new customers, too, right?
Loads. 46% of PowerStore buyers were new to that line, and almost a quarter, 23%, were totally new to Dell storage. That's strong customer acquisition.
So even with the overall dip, they're bringing new people into the fold. Why the dip then?
Part of it, they suggested, is hyper-converged infrastructure customers, HCI folks, are sort of pausing, rethinking their private cloud setups.
Evaluating options before the next big spend.
Probably. But Dell believes their own Dell IP storage will do well, outperform the market eventually.
Okay. And did that mix shift, selling more AI servers, affect ISG's profitability?
It did, temporarily. The operating income rate for ISG was 8.8%, down a bit, because of those early aggressive AI server deals we mentioned.
So they expect that to recover.
Yes, second half. Through value engineering, making things more cost-effective, and just the benefits of scaling up production. It's a classic play. Invest margin early for market share, then optimize.
Short-term pain for long-term AI gain.
Got it. Okay, let's switch gears to the Client Solutions Group. CSG, PCs, workstations. How did they do?
Fairly stable. Revenue was up just 1% to $12.5 billion.
Yeah.
Commercial revenue was a bit better, up 2%. And that's actually the 6th consecutive quarter of demand growth in commercial.
So businesses are still buying.
Yeah, and small and medium businesses, in particular, help profitability there.
And what about the future? There's this big PC refresh cycle everyone talks about.
Absolutely. Driven by, well, old PCs, frankly. And the big one, Windows 10 end of life.
Which is coming up very soon, right?
Very soon. At the time of the call, it was only like 48 days away. That's a huge deadline, pushing upgrades.
Is Dell ready for that?
They're positioning for it. Launched a new business notebook for the entry-level commercial market, for instance.
But how are they feeling about their position overall in PC? Well, reading between the lines of the executive commentary, they're making progress, but maybe a bit unhappy with their market share performance.
Okay. So they want more.
Definitely. The goal is mid-single digits growth for CSG and getting operating margins into that 5-7% target range.
So capitalize on the Win 10 refresh, but also grab more share and boost profitability.
That's the plan. The opportunity is massive, but execution is everything. They need to catch that wave.
Okay, so summing it up, what's the outlook? What's Dell telling us about the next quarter and the full year?
The guidance is optimistic, clearly fueled by that AI momentum continuing.
Give us the numbers for Q3.
For Q3 fiscal 26, they're forecasting revenue between $26.5 and $27.5 billion. Midpoint is $27 billion.
Which is up.
Up 11% year over year. And diluted non-GAAP EPS around $2.45, give or take 10 cents, also up about 11%.
Solid growth expected to continue. And for the full year, they raised guidance there.
They did, significantly. Full year FY26 revenue now expected between $105 and $109 billion. Call it $107 billion at the midpoint.
And that's up.
Up 12% for the year. And EPS guidance also boosted to $9.55 plus or minus a quarter. That's a hefty 17% increase year over year projected.
Wow, 17% EPS growth. That's a big jump in expectations. What's driving that confidence?
It really reflects better profitability expected in the second half for both ISG and CSG.
Recovering margins, like you said.
Exactly. And crucially, they raised the AI server shipment forecast again by another $5 billion.
To what total?
To a staggering $20 billion in AI server revenue for the full year. $20 billion.
That's just huge.
It shows incredible confidence in demand and their ability to deliver. So ISG overall, they see growing mid to high 20%. CSG, low to mid single digits. Storage, they expect to be about flat for the year.
And costs, still keeping those under control.
Yep. Operating expenses projected to decline low single digits for Q3 and the full year. Efficiency remains a focus.
It sounds like the CFO, Yvonne McGill, has a clear plan.
She laid out 4 priorities. Drive revenue and share growth, keep an eye on profitability, keep modernizing their own operations, and deliver strong cash flow and shareholder returns. Pretty straightforward.
And this all fits into that massive AI market growth picture, doesn't it?
Absolutely. The AI hardware and services market, the TAM, is set to almost double by 2028, right? From about $184 billion last year to maybe $356 billion.
And Dell wants a big slice of that pie.
They're positioning hard for it. Their whole investment thesis, their long-term financial model, it's built around consistent growth, strong cash flow conversion, returning capital to shareholders, growing the dividend.
So aiming for that 3-4% revenue growth long-term, 8% plus EPS growth, converting profits to cash efficiently.
Right. Turning over 100% of net income into adjusted free cash flow, returning 80% plus of that to shareholders, 10% plus dividend growth through FY28. It's a model for sustained value creation.
It really paints a picture of a company firing on, well, maybe not all cylinders given the storage dip, but certainly firing very strongly on the AI cylinder and with a clear plan for the future.
No doubt. Dell's Q2 was strong, the outlook is ambitious, And it's all heavily leaning on AI.
Exciting times for them, and really for the whole industry watching them.
Indeed. And maybe this leaves you, the listener, with a thought. As Dell dives deeper into building these AI factories, how is that intense focus going to change their older businesses, like traditional servers and PCs, even faster than we expect?
Good question.
Could we see some surprising shifts in their product mix, maybe even their margin structure, as AI really permeates everything? Definitely something worth keeping an eye on.